A war just broke out. Missile footage is on every screen. Safe haven memes are flying across X and TikTok. And silver just dumped 13 to 19%. Not a small dip, not a healthy pullback. 13 to 19%. On India's MCX, more than 3,500 rupees per kilo gone in a single day. So here is the question nobody is asking correctly right now. Why did the asset that is supposed to protect you in chaos just punish everyone who trusted it? The answer is not what the mainstream media is telling you. And if you get this wrong, if you either panic sell right now or FOMO buy the next spike without understanding this, you are going to hand your position to the exact people who engineered this move. Stay with me, because what analysts are seeing right now changes how you need to think about every metals trade in 2026. This is growth grid logic, not hype. Let's start with the surface level explanation and then go much deeper. The surface level is simple. The dollar surged. The dollar index just climbed to a 3-month high. A stronger dollar makes silver more expensive in every other currency, kills import demand, and crushes commodity prices denominated in USD. That is not wrong, but that is the shallow end of this pool. Here is what analysts are actually flagging. And this is the part that should concern every serious investor watching this right now. The stagflation narrative just snapped back into place. Stagflation, stagnant growth, persistent inflation at the same time. And markets, professional institutional markets, absolutely hate that combination. Not because it is unfamiliar, but because it takes away the Fed's most powerful tool. In a normal inflation scare, here is the playbook. The Fed hikes hard, kills demand, then eventually cuts aggressively to stimulate. Markets can price that. Traders can model that. But in stagflation, growth is already weak. Inflation refuses to roll over cleanly, and policymakers are trapped between two bad options. Hike and you crush a fragile economy. Cut and you pour gasoline on inflation. There is no clean exit. And markets are starting to price in that there might not be one in 2026. That is the backdrop against which silver just got hit. Not a simple dollar move, a full stagflation repricing. And buried inside that repricing are three very specific forces that analysts have been pointing to all week. Let me walk you through each one. Force number 1, the energy shock. Oil is not just another commodity. Oil is embedded in everything. Transport, manufacturing, food, logistics, construction. When oil spikes, inflation expectations spike with it. And right now, oil is spiking on war risk and supply fears. Here's the problem that most retail investors are completely missing. When traders expect higher inflation and weaker growth at the same time, they start revising rate cut expectations downward. The higher for longer yield scenario comes back onto the table. Real yields, that is the yield on bonds minus inflation, stay stubbornly elevated, and non-yielding assets like silver and gold become expensive to hold, especially for leveraged institutions. So paradoxically, even though war should theoretically drive safe haven flows, the energy shock that comes with that war is simultaneously making the case against holding silver. Big money rebalances into cash, short-term paper, or simply de-risks. Silver gets sold. Force number 2, the margin squeeze. This one is critical, and almost nobody in the mainstream coverage is talking about it. CME Group, which runs the COMEX exchange where most silver futures are traded, recently hiked margin requirements on metal futures. What does that mean in plain language? It means the cost of holding your position just went up dramatically overnight. Traders who could not or would not post the extra collateral had two choices: cut their position size or close out entirely. And when large numbers of participants are forced to do that simultaneously, you get a cascade. Prices drop. That drop triggers more margin calls. More margin calls trigger more liquidations. A self-feeding loop that can take prices far below where fundamentals would otherwise suggest. Analysts have been blunt about this. Some of the most dramatic moves we just saw, a meaningful chunk of that 13 to 19%, was not about silver's value as a metal. It was about people being mechanically forced out of positions they might have otherwise held. That is a very different kind of sell-off, and it creates a very different kind of opportunity if you know what you are looking at. Force number 3, the industrial demand fear. This is where silver's unique profile becomes a vulnerability, at least in the short term. Gold is roughly 90% monetary and jewelry demand. Silver is roughly 50% industrial. Solar panels, electronics, solder, EV components, AI data center infrastructure. And here is the uncomfortable question the market is now asking. If war-driven uncertainty pushes the global economy toward recession, who buys all the solar panels, the chips, the EV components? Capital expenditure gets frozen, projects get delayed, orders get cut. Industrial demand for silver can fall hard and fast in that environment. Gold does not have that problem to the same degree. Gold just needs to be a store of value. Silver has to answer two questions simultaneously. Is it a safe haven? And is industrial demand holding up? In a stagflation shock, both answers get questioned at the same time. Put all three forces together, and here is what you get. Energy shock, margin squeeze, industrial demand fear. That is a risk-off cascade where everything gets sold. Stocks, bonds, metals, crypto. Not because any of these assets suddenly became worthless, but because the market just entered a liquidity phase. Raise cash now, ask questions later. The war script did not break because silver stopped being valuable. It broke because the market temporarily stopped caring about value. Now let's talk about the specific price levels that every serious analyst is watching right now. Because in a market this volatile, you do not trade opinions, you trade levels. And there are two zones that define everything in silver for the rest of 2026. Zone 1, the floor, $80 to $84. This is what analysts are calling the must-hold zone. It lines up with prior consolidation. It aligns with where major institutional desks have placed their average 2026 price targets. Some of the largest banks on Wall Street have published numbers around $81 as a base case for the year. That is not a prediction. That is an instruction to their clients. Accumulate in this zone. As long as silver holds above $80 on weekly closes, the macro uptrend is damaged but not dead. Pullbacks into the high 7s and low 80s are being described as buy the dip zones for long-term capital. This is where forced liquidations get absorbed by institutions with dry powder. But, and this matters, if silver delivers a decisive weekly close below $80, analysts start talking about a retest of the February low around $71. That is the scenario where weak hands and late buyers get fully flushed. Zone 2, the ceiling, $90 to $96. On the upside, the level analysts are watching most closely is $91 on a daily close. Not 90, not 93, 91 on a daily close. Here is why that specific level matters so much. A convincing daily close above 91 sends a very specific technical signal. It tells institutions that the war flush and the margin squeeze were a correction, not the beginning of a new bear market. It confirms that the buyers who stepped in at the lows have real conviction. Above 91, the prior recovery high around 96 comes back into play. And above that, the psychological level at $100. That is where the next phase of the bull market gets confirmed. But until 91 is broken and held, the base case is a consolidation band. Not a crash, not a moonshot, a band. 80 to 84, danger and support. 90 to 96, resistance and confirmation. That is the battlefield for silver in 2026. So let me be direct with you about what all of this actually means for how you should think and act right now. The most important insight from analyst commentary this week is this. The safe haven trade is not broken. It is being temporarily overshadowed by a liquidity crisis. In true panic conditions, markets do not discriminate. They do not sell only the bad assets and protect the good ones. They sell everything that has a bid. Hedges, safe havens, long-term positions, all of it goes to meet margin calls, to pay redemptions, to reduce risk in size. This is not a silver story. This is a liquidity story that silver got caught in. Now here is what has not changed. The physical supply deficit for silver is still projected near 200 million ounces for 2026. COMEX registered inventories are down approximately 70% since 2020. Eastern demand and industrial flows have not reversed. Silver's role in solar energy, artificial intelligence infrastructure, and electric vehicles is structural, not cyclical. Price is a war zone right now, But the underlying reality is moving on a different, slower timeline. And that gap between short-term panic selling and long-term supply-demand math is where intelligent money is made. You have two choices in this environment: trade the headlines and play on the timeline of the people who create the volatility, or accumulate intelligently and play on the timeline of the supply-demand reality. If you understand that 80 to 84 is a real support battle, that margins forced mechanical selling with no fundamental basis, that the 200 million ounce deficit does not disappear because there is a war, then you can use dips in the high 7s and low 80s to add, instead of dumping your position into the hands of the very participants who engineered the scare. Analysts are not saying silver is finished. They are saying the path will not be a straight line. And that is exactly what creates asymmetric opportunity for patient capital. So let me leave you with the clean summary of what analysts are actually telling silver investors right now. The rules of the war trade have changed. War plus stagflation plus higher for longer rates plus margin hikes equals volatile, messy price action, not a clean, safe haven rally. The lines that matter: $80 to $84 as immediate support, 90 to 96 as confirmation resistance. The instructions from Big Money: buy on dips, do not chase spikes. The reality that has not changed: the supply deficit, the drained inventories, the structural industrial demand. The vultures want you to panic. They want you to sell into the 80s so they can quietly add size and ride the next leg without you. Do not give them your ounces at a discount just because the war script did not play out in a straight line. If this breakdown gave you clarity, hit subscribe. Growth Grid covers rates, metals, and macro every week. No hype, no speculation, just the data and what it actually means. Drop your questions in the comments. I read everyone. Stay sharp.